Riding the roller coaster, Q4 corporate earnings take center stage. The last quarter of the year, it's always a nail-biter. Companies scrambling to meet targets, investors glued to their screens. Q4 2023 was no different. A mixed bag of results hit the headlines, painting a complex picture of the global economy. Some sectors soared, others stumbled. Profits swelled for some, while others faced revenue dips. It's a high-stakes game, and Q4 showed who played their cards right. The tech sector, usually a reliable growth engine, hit a few speed bumps. Supply chain disruptions and cooling consumer demand put pressure on even the biggest players. The energy sector, on the other hand, rode the wave of high oil prices to impressive gains. Retail saw a mixed bag, with e-commerce giants continuing their dominance, while brick-and-mortar stores grappled with changing consumer habits. These sector-specific trends highlight the uneven nature of economic recovery. This quarter wasn't just about the numbers, it was about the stories behind them. The decisions made, the risks taken, the challenges overcome. Each earnings report offered a glimpse into the inner workings of these corporate giants. We saw companies adapting to a rapidly changing world, from supply chain bottlenecks to evolving consumer preferences. The ability to pivot, to innovate, proved crucial for navigating this uncertain terrain. Understanding these narratives, beyond the raw data, is key to deciphering the true meaning of Q4 results. It's about connecting the dots, seeing how individual companies contribute to the broader economic tapestry. This analysis goes beyond mere financial reporting. It delves into the strategic decisions, the industry shifts, the global forces shaping the corporate landscape. And in Q4 2023, that landscape was anything but static. Profit engines and revenue streams, decoding the numbers. The raw numbers tell a tale. Profits, the lifeblood of any business, saw significant fluctuations in Q4. Some companies exceeded expectations, posting record profits driven by strong demand and operational efficiency. Others fell short, citing supply chain disruptions, rising input costs, and changing consumer behavior. These variances underscore the volatile nature of the current market, where agility and adaptability are paramount. Revenue streams, the inflows fueling these profit engines, also presented a varied picture. Tech giants continued to rake in substantial revenue, fueled by cloud computing and digital advertising. The energy sector, buoyed by high oil and gas prices, saw revenue surges that translated into impressive profits. Retail, however, experienced a more fragmented landscape, with online giants thriving while traditional retailers struggled to maintain their footing. Examining revenue trends reveals key market dynamics. The rise of e-commerce continues to reshape the retail landscape, demanding adaptation from traditional players. The energy sector's dependence on commodity prices underscores the inherent volatility of this industry. Tech's reliance on digital advertising revenue highlights the importance of navigating evolving consumer preferences and data privacy concerns. Understanding these revenue streams, their drivers and potential vulnerabilities, is crucial for assessing long-term corporate performance. It's not just about the top-line figure, it's about understanding the composition of that revenue, its resilience in the face of market shifts, and its potential for future growth. In a rapidly evolving market, deciphering these revenue streams offers critical insights into a company's ability to thrive in the years to come. Dividends, delight sharing the spoils of success. Dividends, a tangible reward for investors, took center stage in many Q4 announcements. Companies flush with cash, driven by strong profits and a positive outlook, opted to share the spoils with their shareholders. Increased dividend payouts signal confidence in future earnings, a reassuring sign for investors seeking steady returns. These announcements, often met with market enthusiasm, reflect a company's commitment to rewarding its investors. However, dividend payouts weren't universal. Companies facing headwinds, grappling with declining profits or uncertain futures, took a more cautious approach. Maintaining financial stability, investing in future growth, or weathering economic storms took precedence over shareholder payouts. This prudent approach, while potentially disappointing for some investors, demonstrates a commitment to long-term sustainability over short-term gains. The decision to distribute dividends or withhold them provides valuable insight into a company's financial health and strategic priorities. A robust dividend payout suggests a strong financial position and positive future expectations. Conversely, a decision to conserve cash may indicate a need to address internal challenges or navigate external uncertainties. These choices, far from arbitrary, reflect calculated assessments of current performance and future prospects. Analyzing dividend announcements requires understanding the underlying rationale. It's not simply about the dollar amount, it's about deciphering the message behind the decision. Is it a signal of strength and confidence? Or is it a strategic move to conserve resources and weather a potential storm? Understanding these nuances is crucial for investors seeking to gauge a company's financial health and future trajectory. Sector Spotlight: Winners and Losers in the Q4 race. Q4 earnings painted a diverse picture across different sectors, highlighting the uneven nature of economic recovery and evolving market dynamics. Some sectors emerged as clear winners, capitalizing on favorable market conditions and strong consumer demand. Others faced significant challenges, grappling with supply chain issues, rising costs, and changing consumer preferences. This sector-specific performance underscored the importance of understanding broader economic trends and their impact on individual industries. The technology sector, typically a growth engine, experienced a mixed bag in Q4. While software and cloud computing continued to perform well, hardware and semiconductor companies faced headwinds from supply chain disruptions and cooling demand. The energy sector, however, emerged as a clear winner, reaping the benefits of high oil and gas prices. This sector's performance highlighted the impact of geopolitical events and commodity market volatility on corporate earnings. The retail sector showcased a stark divide between online and brick-and-mortar players. E-commerce giants continued to thrive, capitalizing on the ongoing shift towards online shopping. Traditional retailers, however, faced challenges from increased competition, evolving consumer habits, and rising operating costs. This divergence underscored the ongoing transformation of the retail landscape and the need for traditional players to adapt to the digital age. Analyzing sector-specific performance provides a nuanced understanding of the forces shaping the corporate landscape. It goes beyond simply identifying winners and losers. It's about understanding the underlying factors driving these outcomes, whether it's technological advancements, geopolitical events, or evolving consumer behaviors. This analysis allows investors to make informed decisions, identifying sectors poised for growth and those facing potential challenges. The FDA factor: navigating regulatory waters. For companies operating in highly regulated industries, such as pharmaceuticals and healthcare, the impact of regulatory bodies like the U.S. Food and Drug Administration is paramount. The fourth quarter saw several instances where FDA decisions significantly impacted corporate earnings, highlighting the crucial role regulatory approvals play in these sectors. Positive FDA rulings can propel a company's stock price, while rejections or delays can have a devastating impact on revenue projections and investor confidence. One notable example involved a pharmaceutical company receiving FDA approval for a groundbreaking new drug. This long-awaited approval sent the company's stock soaring, as investors anticipated a surge in sales and market share. Conversely, another pharmaceutical company faced a setback when the FDA rejected its application for a new drug, citing concerns about its efficacy and safety. This rejection led to a sharp decline in the company's stock price as investors reassessed its future prospects. These examples demonstrate the significant influence regulatory bodies wield over corporate fortunes, particularly in industries where product approvals are critical for market access. Navigating the regulatory landscape requires significant investments in research and development, rigorous clinical trials, and meticulous documentation to meet stringent safety and efficacy standards. Failure to secure regulatory approval can result in substantial financial losses, delayed product launches, and damage to a company's reputation. Understanding the FDA's role and its impact on corporate earnings is crucial for investors in these sectors. It requires staying informed about ongoing clinical trials, regulatory submissions, and potential approval timelines. Analyzing a company's track record with regulatory bodies, its ability to navigate the approval process, and its preparedness for potential setbacks provides valuable insights into its long-term prospects in these highly regulated industries. Turbulence ahead, challenges on the horizon. While the fourth quarter earnings provided a snapshot of corporate performance, they also revealed potential challenges looming on the horizon. Global economic uncertainty, geopolitical tensions, and ongoing supply chain disruptions cast a shadow over future prospects, demanding vigilance and adaptability from corporate giants. These external factors, coupled with internal challenges like rising input costs and labor shortages, necessitate strategic planning and proactive measures to mitigate potential risks. Inflation, a persistent concern, continued to impact corporate earnings in the fourth quarter. Rising input costs, driven by supply chain bottlenecks and increased energy prices, put pressure on profit margins, forcing companies to carefully manage expenses and potentially raise prices. This delicate balancing act between absorbing rising costs and passing them on to consumers requires careful consideration of market dynamics and consumer sensitivity to price changes. Geopolitical tensions, particularly the ongoing conflict in Europe, added another layer of complexity to the global business environment. Disruptions to supply chains, increased energy costs, and potential trade restrictions created uncertainties for companies operating in affected regions or reliant on global supply networks. Navigating these geopolitical complexities requires flexibility, contingency planning, and a willingness to adapt to evolving circumstances. These challenges underscore the importance of proactive risk management and strategic planning. Companies need to anticipate potential disruptions, develop contingency plans, and diversify their supply chains to mitigate vulnerabilities. Investing in technology, automating processes, and exploring alternative sourcing strategies can enhance resilience and adaptability in the face of unforeseen events. Investor sentiment reading the tea leaves. Q4 earnings announcements had a profound impact on investor sentiment, shaping market reactions and influencing stock prices. Positive earnings surprises, exceeding analyst expectations, often triggered surges in stock prices, reflecting investor confidence and optimism about future prospects. Conversely, disappointing results or warnings of future headwinds could lead to sharp declines in stock prices, as investors reassessed their valuations and adjusted their portfolios accordingly. The tech sector, known for its volatility, saw significant swings in investor sentiment based on Q4 performance. Companies exceeding expectations, particularly those demonstrating strong growth in cloud computing and artificial intelligence, were rewarded with enthusiastic investor support, driving stock prices upward. However, companies reporting slowing growth or facing challenges in key markets experienced a decline in investor confidence, reflected in downward pressure on their stock prices. The energy sector, benefiting from favorable market conditions, enjoyed a surge in investor interest. Strong earnings, driven by high oil and gas prices, attracted investors seeking exposure to this sector's growth potential. This heightened interest, coupled with expectations of continued commodity price strength, fueled stock price appreciation, making energy stocks a popular choice for investors seeking robust returns. Investor sentiment, often driven by a mix of rational analysis and emotional responses, plays a crucial role in shaping market dynamics. Understanding the factors influencing investor perceptions, interpreting market signals, and assessing the overall sentiment surrounding a particular company or sector is crucial for making informed investment decisions. This requires staying informed about earnings announcements, analyst reports, and broader market trends to navigate the often turbulent waters of the stock market. Market echoes ripples from Q4 results. The impact of Q4 earnings extended beyond individual companies, creating ripples across the broader market. Strong overall performance, particularly in key sectors like technology and energy, contributed to a positive market sentiment, boosting investor confidence and fueling continued market growth. Conversely, disappointing results or warnings of future challenges could dampen market enthusiasm, leading to increased volatility and potential market corrections. Positive earnings surprises in the tech sector, a bellwether for the broader market, often had a spillover effect, lifting other sectors and contributing to a general sense of optimism. This positive sentiment, fueled by expectations of continued innovation and growth, encouraged investors to maintain or increase their market exposure, driving overall market performance upward. Conversely, weakness in the tech sector could trigger a broader market downturn as investors reassessed their risk appetite and sought safer havens. The energy sector's performance also played a significant role in shaping market dynamics. Strong earnings, driven by high commodity prices, attracted investors seeking exposure to this sector's growth potential. This increased demand for energy stocks, coupled with expectations of continued price strength, fueled a broader market rally, particularly benefiting companies operating in related industries like industrials and materials. Understanding the interconnectedness of different sectors and the ripple effects of individual company performance is crucial for navigating market dynamics. Analyzing earnings trends across various sectors, identifying potential spillover effects, and assessing the overall market sentiment provide valuable insights for making informed investment decisions. This requires a holistic perspective, considering both individual company performance and its potential impact on the broader market ecosystem. Beyond the bottom line, the intangible factors. While financial metrics like profit and revenue are crucial indicators of corporate performance, Q4 earnings also highlighted the significance of intangible factors. Brand reputation, customer loyalty, and a company's ability to innovate and adapt to changing market dynamics play a pivotal role in shaping long-term success. These intangible assets, often difficult to quantify, contribute to a company's competitive advantage and its ability to thrive in a rapidly evolving world. Companies with strong brand recognition and a loyal customer base enjoy a significant advantage in the marketplace. Their established reputation, built on trust and positive customer experiences, allows them to command premium prices, attract new customers, and weather economic downturns more effectively. Investing in brand building, fostering customer loyalty, and prioritizing customer satisfaction are crucial for cultivating these intangible assets. Innovation, the lifeblood of any company seeking long-term success, is another critical intangible factor. Companies that invest in research and development, embrace new technologies, and adapt their products and services to meet evolving customer needs are better positioned to thrive in a competitive landscape. This ability to innovate, to anticipate, and respond to market shifts is crucial for sustaining growth and staying ahead of the curve. Analyzing these intangible factors requires going beyond traditional financial metrics. It involves assessing a company's brand strength, its customer satisfaction ratings, its track record of innovation, and its ability to adapt to changing market dynamics. These qualitative assessments, while more subjective than financial data, provide valuable insights into a company's long-term potential and its ability to navigate future challenges. Crystal ball gazing. What's next for corporate giants? Q4 earnings provided a glimpse into the current state of corporate performance, but the true test lies in the future. The ability to sustain growth, navigate economic uncertainties, and adapt to evolving market dynamics will determine the fate of these corporate giants. Looking ahead, several key factors will shape the corporate landscape, demanding strategic foresight and proactive measures to ensure continued success. The global economic outlook, clouded by geopolitical tensions, inflation concerns, and potential recessions, presents a significant challenge for corporate planning. Companies need to carefully assess market trends, develop contingency plans, and prioritize financial prudence to weather potential economic storms. Diversifying revenue streams, exploring new markets, and optimizing operational efficiency can enhance resilience and mitigate risks in an uncertain economic climate. Technological advancements, a constant force for change, will continue to reshape the corporate landscape. Companies need to embrace digital transformation, invest in automation, and leverage data analytics to optimize their operations, enhance customer experiences, and unlock new growth opportunities. Staying ahead of the technological curve is crucial for maintaining competitiveness and relevance in a rapidly evolving marketplace. The evolving consumer landscape, driven by changing demographics, digital preferences, and heightened social awareness, demands adaptability from corporate giants. Companies need to understand these evolving consumer needs, personalize their offerings, and prioritize sustainability and ethical practices to resonate with today's discerning consumers. Building trust, fostering authentic connections, and demonstrating a commitment to social responsibility are crucial for cultivating lasting customer relationships in the years to come.